Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Monday, 15th of March. My name is Carl Cappelling. I'm the market analyst over here at ThinkMarkets, and it is a pleasure to be with you as we look at everything that happened last week and have a good look at the week ahead as well. We'll talk about that after we talk about the ThinkMarkets Difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. 4 fantastic reasons to make sure that your next ASX share trade is with ThinkMarkets. The agenda for today is to have a look at the key market moves from during the week. We'll check up on the current COVID situation, see what's going on the macroeconomic data side of things, check out what the brokers are saying about our stocks at the moment, have a look and see where the value is in the Aussie market, see what the technicals are saying, and then have a look to the week ahead. Okay, we'll kick off with what happened on the local market. Monthly comparisons not so good, down about 1.2%, and that's because we have been lagging the rest of the world. We've seen this huge rotation from technology, high growth plays that have benefited from that switch to work from home, innovation, just the usual technological change that we've had. And that's occurred at the same time that a lot of those value and cyclical stocks that have been exposed, that are exposed to the ebbs and flows of the global economy, they have struggled, of course, because the global economy has been severely depressed due to COVID. So at the moment, we're seeing the move back the other way, where technology stocks are suffering and some of those value cyclical plays are doing very well. And that's caused a bit of a, internal struggle within the Australian market. So some of those high-flying sectors are pulling back, yet some of the beaten down sectors are rounding a net. We haven't gone very far for the last month or so. The week wasn't too bad, if you could call up 0.9% a good move, but hey, it could have been worse given some of the struggles that are going on in the markets at the moment. The ordinary is up 0.2%. Discretionary sector did very well, up 3%. I'm going to say that's the star performer, is it? Not quite. The utilities up 3.5%, gold up 2%, and the rest of them there, much of a muchness. We did see a bit of a pullback in the materials sector, down 1.4%, then property trusts down 1.2%. Volatility index, that's not a bad thing if that one's coming down 9%, because volatility is very rarely the friend of investors. Having a look at the charts there, we can see straight away this big rotation out of those technology shares into some of those consumer discretionaries, and I know it's hard to see on this chart, but the financials in there, that's that one there heading up. Having a look at what that all means for the ASX 200, so put it all in the pot, stir it around. It doesn't mean a whole lot. Over the last few weeks, we've been going fairly sideways. It would be good to see us find some synchronous growth in those sectors and see also a break of 68.61, which I think would give us a bit of a flag that we're going to move higher. The train is just starting to leave the station. Telling us that the train is starting to get up to speed would be a breakthrough 69.38, and then we could target into 71.97, which is that all-time high set on the 20th of February last year. On the flip side, if we were to get below 66.48, that would be bearish, and I would be very concerned for a test of 67.17, and I don't even want to talk about how bad it could get if we get below that level there. So we don't want to see that, but we do want to see this, and these are very tried and true technical analysis symbols there, aren't they? Let's have a look at what the rest of the world did. Well, pretty much everywhere except for the Chinese focus markets did pretty well last week. So the Nikkei up 2.72%. That's pulled back a little bit lately. It's been one of those high-flying markets, as has been the Shanghai Composite Hang Seng, who didn't get the benefit of a rally yesterday. Now, the Chinese government came out during the week and made some noises about just slowing things down a little bit, saying that there was a little bit of speculation in some of those frothier areas of the economy, including speculation on iron ore and some of those minerals prices. So I wouldn't say they're slamming on the brakes, but they're just tapping on a few of the brakes in a few of the areas that they feel are overheated, and that's causing some of this disappointment here in the form of lower prices on their shares. But overall trends are still very strong. I wouldn't look at that and say, well, that's something I need to be too worried about here just yet. But it has caused a little bit of softness in our materials sector over the last week or so. Having a look at the Dow Jones Industrial Average, that is a big move there. Now that index in particular has a lot of those old school value and cyclical names in it, and therefore it has outperformed the other US indices, for example the S&P 500, but still a fantastic move at 4.6%. The Nasdaq is bouncing back after 12.8% decline through sort of February, early March. Bouncing back by about 4.7%. As I said, it's good to see when volatility is coming down, and it's come down quite a lot actually over the last week or so, by nearly 30%, and that is a good thing for markets going forward. Interestingly, this time around, compared to some of the other rallies in the US, we are seeing Europe coming to the party. So the FTSE's up nearly 2%, the DAX has broken to an all-time high, think about that, post-pandemic, and an all-time high, up 3% during the week, but some of the markets, like France, Spain in particular, doing very well. France was up 3.7%. Looking at some of those commodity prices from during the week, and LME stands for London Metals Exchange, we can see that those issues in China having a bit of a negative impact on, for example, lead, nickel down 2%. Now that's down quite a lot from its recent highs by about 18 to 20% there, but that was more of a supply side issue, not helped by the China situation, but a bit more of a supply side issue. And they do occur from time to time. Steel down 2%. That's one of the key markets that the Chinese are targeting at the moment. That's steel and therefore the iron ore market. But tin, there's a major shortage of tin at the moment. That was up 5%. Zinc up a little. Copper, good to see that firming in the US and firming a little bit in London as well. But iron ore, one of the casualties of the moves in China. We've seen that falling about 6% on the Dalian exchange in Shanghai, and then about 3% in the US dollar price. Precious metals down the bottom here, generally stronger during the week, but they have been hit over the last couple. Oil price pulled back, but it's had a really good month, as we can see here, up 9% for that month on West Texas crude oil, and up over 100% on a year-on-year comparison, but not hard to do when you think about those lows in oil prices were actually in negative values back just after the pandemic began. Brent crude down a little, but again up for the week. Natural gas down and down week on and month. Australian dollar bounced back a little, up about 1% as the US dollar index was pretty flat. US and 10-year bond yields on the rise, and that is one of the key issues at the moment for markets. The reason why we're seeing this big switch from growth to value is the rising inflation expectations, and accompanying that rising yields to compensate, long-term bond investors for those rising inflation expectations. So US 10-year notes up 8.1 basis points for the week, but we can see they're up over 118 basis points for the month, which is extraordinary, and the Australian bonds up 1.6 basis points, I should say, for the week, but up 138 basis points for the month. And now this is because we are seeing a switch back to expectations for inflation. We've gone from expectations of zero inflation up to about 2.5%. So we'll have just a quick look at some of these bond yield charts, and you've probably been hearing about the negative impact this is going to have on the Australian market. Now, the good news is that historically, if you go back, when yields have risen, there has been a temporary negative impact on the stock market, but then overall, the stock market tends to rise after those rising yields. The problem is the adjustment process and the uncertainty of how quick and how fast yields are going to rise when they're doing it. And that's why we're seeing this push and pull in markets at the moment. Largely, stocks are still taking this in their stride and still fairly positive. But when you go from, and this is the 130 basis points, when you go from about 0.7% into nearly 2%, it's a major shock for the market that needs to be digested. And most analysts, including myself, are thinking we're pretty close to the top of the range here, somewhere around 2. In the worst case, could get to 2.2, it could be 2.5%, but we don't think we're going to go higher than that. There just isn't a case for it. In terms of the US yields, we can see those also rising as well, and that is driving this switch from growth to value. And that chart doesn't make a lot of sense until you zoom it out. And this is the Nasdaq divided by the Russell 2000. The Nasdaq, more of that technology high growth sector, and the Russell 2000, the broader market in the US. You can see that this phase here is the pandemic where growth stocks surged, and this phase here is this switch back to value. We haven't seen a move of this magnitude really since the dot-com crash, where tech stocks to be fair, got ahead of themselves, and maybe that's the case here as well. It's part of this sharpness, this rotation back. But the point of this chart, I think, is that there's still potentially a long way we can go here. So don't just necessarily buy those tech stocks just because they've gone down. There could be a bit more of a move in this. So be careful there. The other chart probably worth watching here is Bitcoin. Looks vertical on that monthly chart. If we head back to the daily chart, we can see it is making new all-time highs here above 60,000. So 50,000 was a big psychological level, appears to be a great base now from which to attack some of these high levels. And if you look at this move here from 28,745 into 58,446, and then extend that up from this last swing low at 43,021, you get into the 73,000s. And we do know that there are a bunch of people in America about to get their $1,400 stimulus checks. And no doubt part of that from the younger generation is going to find its way into Bitcoin investments. And as the young people say these days, YOLO, which stands for you only live once. If you're old like me and didn't know what that meant and had to Google it. Okay, if you're old like me, you were certainly around in the GFC correction or crash, whatever you want to call it, and rally. You're probably around for a few others like that .com crash and rally as well. It's definitely in that one. And a few preceding that as well. I'm giving away my age here. But how are we going this time around? How are we going in this COVID crisis compared to the last crisis? And that's the blue line, light blue line. And the last time, the GFC is the orange line. And it is uncanny how similar these moves are. And of course, you have a big problem in the global economy. You need to solve it by throwing a lot of money at it. And that's what happened last time. And to be fair, that's what's happening this time. So we're seeing fairly similar moves here. They say history doesn't repeat, it sure does rhyme, and it's rhyming now, even to the point we had this little correction here, and we've been watching this for a while. We do it for fun, everybody. We don't do this because we seriously think that the blue line has to follow the orange line. But we were getting to this point here, and we're thinking, well, is there a correction ahead? And funnily enough, rates spiked up 100 odd basis points, and there was a little correction there. But after that correction, if we're maybe a little bit ahead of the curve here, there was a pretty good period into these highs, and then you have to see where we go from there. But anyway, look, heads up on that one. Certainly, the technicals are supporting, and even you didn't say the fundamentals are supporting a move high from here. And this is largely because this situation is getting under control. That's obviously still horrible. But it's good to see the United States falling down the list and actually falling below Brazil. The situation's still very bad there. But as the vaccines start to roll out, and fingers crossed they start to reach some of these other countries as well, not just the developed countries, we should see this situation come down and get in hand. Italy is one of the major hotspots at the moment. But good to see the trends heading down, I guess, in the US. Obviously in Australia, largely under control. In China, it looks to be under control there. We don't like to see this on a chart, a double bottom. That's usually a negative sign. But I think it's on the back burner at the moment for the markets as long as the vaccines continue to roll out as they are. Have a look at what happened during the week on the economic data front. We had NAB business. I'm just checking my notes over here. That's why I'm looking away from the camera. NAB business confidence rose 4 points in February to get to 16 points. The gain was broadly based, with all states and industries recording an increase. Retail was one of the underperformers there. But I think what we can take out of these are not necessarily the raw stats, but more the trend. And the trend is your friend in that case. And we're seeing increasing confidence on the business side of the equation. And that is a great forward-looking indicator for the Australian economy. Also very forward-looking, consumer sentiment. Consumption is about 2/3 of GDP. So if we're confident in our situations, then that's going to lead into spending down the track. And we saw a little bit of a dip here. A lot of that was to do with those spot lockdowns during December and January in some states. But it looks like we're on the right side of that. Vaccines are on their way. In fact, they're being rolled out as we speak. So we are seeing a bit of a tick back up in consumer confidence, and we saw it print 111, and that was up from 109 previously. And once again, it was broad-based in terms of those sub-indices there. The economy next 12-month sub-index was up 3.7%, so even bigger than that overall rise. Next 5 years up 2.3%. Family finance assessments improved. They were up 2.8%. Time to buy major household items. That's big for the consumer discretionary sector. That was up 3.7%, major jump there. The unemployment expectations index fell, and that's good because you don't want to be unemployed, of course. That fell by 2.2%. And the wisest place of savings, this is quite interesting. I picked this out in the survey. Just 9.3% of consumers nominated real estate as the wisest place for savings, indicating that we're starting to react negatively to some of those price increases there. It's the third lowest result in 47 years. And more consumers, 10.5% in fact, favour shares than real estate. So that's a good thing for the share market. Have a look at what was happening in China. We saw there's been a broader pullback in the money supply over the last few months, but a tick up last month, and we saw the new loans fall quite sharply there. It is something the Chinese government is targeting at the moment. External trade balance, and part of the reason why they're targeting is in this next chart here, and their economy is absolutely going gangbusters at the moment. So there's just little dots because we had the Chinese New Year pause in there. That's quite common, but you can see exports, and that some of these previous numbers are obviously zero as a result of the break there for Chinese New Year. So I've seen a massive growth in both imports and exports. Imports were up, I'll give you the numbers here, 22%. Exports were up 60%. And the trade balance there reached a surplus of $100 billion. And they are absolutely staggering levels of growth. And maybe you can see why the government wants to just cool things down a little bit, because they don't want to see it turn into this here, which is inflation. That's inflation at the wholesale level. That's the producer price index. So that's business to business inflation. So we've seen a pop back up in that. Nothing to get too concerned about, of course, because we're well off, the average, I guess, pre-pandemic. But we want to keep an eye on it. Consumer inflation is still non-existent in China, so that won't worry them too much. Have a look at some of the inflation data in the US. Now, some of these big moves in global markets have occurred because of rising inflation expectations. And as we get the data, does the data match the expectations? Well, not really. We're not seeing a lot of inflation out there at the moment. In the US, the consumer price index up 0.1% only, and that was below market expectations, in fact, and from a zero reading the month before. So we're not seeing this actually in terms of the core inflation occur yet. In terms of the headline inflation, now core inflation strips out some of those more volatile food and energy sectors because they go up, they go down. So if you keep putting them in and then you have to keep backing them out, it can be quite confusing. So we strip them out and we use the core. And that's what the Fed looks at. But if you put back in the energy and food, you get the headline, and that was up 0.4%, but still not enough to worry markets. Even on a headline basis, we're looking at 1.7% increase year on year, which the Fed wants that inflation level over 2%, so that is not going to bother them, and you didn't see anything too exciting on the producer side of things as well. Other US economic data out during the week, weekly jobless claims declined slightly, but are still very high, and we do know there's a bunch of stimulus aimed at the US economy to sort that out, but the trend, very modestly is down at this point in time. Continuing claims also falling. University of Michigan Consumer Sentiment Index starting to make a little bit of a turn up here, but the US economy has been severely impacted by COVID. We've had it very good over here, but nonetheless a nice pop there from 76.2 to 83, and that was better than the 78.4 the market was expecting. As I said before, consumer sentiment, it's all about consumption, 2/3 of GDP, and that's a good sign going forward. Having got some of the broker moves from stocks of interest during the week, the government unveiled its stimulus package for the travel sector, cheap airfares just being one of the tools being used there. Qantas clearly a major potential beneficiary from those moves. Citigroup came out during the week as a result and upgraded their rating from neutral to buy. They raised their price target, quite a nice rise indeed, from $5.47 to $6.14. They said they're reacting positively to that stimulus package aimed at the travel sector. It reduces the uncertainty, not just for Qantas, but for the broader sector. And in terms of Qantas' situation, they are on a major cost-cutting program at the moment, $1 billion to be stripped out of costs to be stripped out of the business. So Citigroup seeing some big upside from that as well. JP Morgan upgraded Qantas from hold to buy. They increased their price target from $5.50 to $6. They said the company is one of the best placed to generate strong cash flows as a global travel recovery develops. And the massive cost reduction program will also deliver benefits, and the balance sheet is getting stronger. That's important. UBS retained their buy rating and their price target. From the top of my head, I think that's about $6.30. They said customer behaviour is returning to normal with respect to domestic travel, and that's the bulk of Qantas's profits right there. And the company is on track to achieve its $1 billion cost-cutting program. The broker expects that operating leverage could see a significant improvement in the balance sheet. So that's just the ability for revenues to increase and costs to decrease because of the actions they're taking and the stimulus that's coming in, and that could see potential for surprise to the upside in FY21 results. What do the rest of the brokers say about it? We've got 2 strong buys at the moment, 6 buys, 3 holds, just the 1 sell. So that's pretty positive, an average rating of a buy. The mean estimate of 555 is a little higher than where the share price is right now, but I would expect that this would increase with these updates here, that this data provider takes a week or so to catch up to things. In terms of the company's fundamentals, look, there's no point really looking at this because COVID has driven a truck through earnings, and of course, FY20 was a write-off. FY21 expected to be nothing special either, and it won't be until we get to FY22 that we start to see some good earnings come back into the company. At a P of 15 for that period, it's certainly not expensive. This was a great dividend payer before the pandemic. It's going to take a while, clearly, as you can see there, to get back to anything that resembles a good dividend, but we are expecting some really good return on equity figures to come back in as that operating leverage, as UBS puts it quite succinctly, comes into play. So, yeah, look, big question mark over there. Obviously, that's a tick. The chart's a tick. I think this looks pretty good here. We've got a short-term uptrend in place. We've got the long-term uptrend just commencing now as this recovery from this COVID low. Great base pattern through here. We're seeing the step up, base, and then moving off that base. I think this one looks very good, actually, and we could come back up to these levels, which is just over $7 as a result. So on the basis of the 2 out of 3 ticks, I think I'm happy to buy Qantas. Treasury wine estate looks very interesting at the moment. Also, we can see short-term uptrend, long-term downtrend, but that's looks like it's about to change. We've also got this great base pattern here, and I really think it has banged out this low, and I think the balance of probability suggests that we have seen the low and we can now move higher. Obviously, want to get through 1192 and that level there, whatever that is. But I think then we are skewed to the upside. On Treasury wine estate, it is a high-risk play because of, this is a turnaround play. This is not bottom left, top right, and that increases the risk. But I think it looks very interesting here. Credit Suisse downgraded that. They're obviously not looking at the charts like I do, but they downgraded their rating from outperform to neutral. It wasn't necessarily because of bad news. Actually, there was some good news during the week. They did raise their price target from 11 to 11.30 on the news that they would sell, or Treasury Wine Estates would sell $100 million worth of wine to the wine group in a deal to offload some of their lower margin, lower value products as they refocus towards more premium brands. So the market rallied on that news, and Credit Suisse saying, well, that rally has made them sort of less attractive as a result, and therefore they downgraded the rating. JP Morgan essentially said the same thing as they raised their price target to 11.50, and Citigroup will also raise the price target as well, but they retained their sell rating. Brokers, you wouldn't say, are as convinced about this one as they are on Qantas. The average is a hold there, and the bulk of them are in that zone, but there are a few buys out there. The mean price target at the moment is 11.12, but I would expect that to head a little higher on the basis of those revisions. In terms of the fundamentals, not fantastic. That PE is too high for me, and that growth rate is too low. It just doesn't justify that high PE at this point in time. But we know they've had some problems with their China wine exports, and they're looking for new markets and looking to repivot. So it's a fluid situation. The dividend yield is 2%, not too bad. Return of equity is not fantastic. So yeah, look, definitely a question mark there, and an interesting but high risk tick on the chart. Look, make of that what you will. Okay, ASX Value Insights. Is there value in the Australian market? Well, overall, our PE is 18.36, which compared to the other developed markets at 20.37 is more attractive. Okay, we're less expensive, because once you get over 20, you're really starting to call the market expensive. 15 is fair value and 10 is considered to be very, very cheap. We can see this spread is increasing, so we're becoming cheaper as time goes on, as I guess we're missing out some of those gains. So, that's generally a positive that we're not as expensive as some of those other markets out there. We're seeing the technology sector PEs come down because those prices have fallen. Not necessarily because their earnings are going down, but just simply prices are coming back, and at 64.8 from an eye-watering level of 71.5, they're still extremely high. The rest of the pack's down here. The best value is materials at 12.5 without a doubt. And the charts still look pretty good there, so happy with that one. Financials not too bad, charts look great there. And then energy is coming in, and property as well. And then the rest are in the mid-20s, and you would not say they are cheap at all. Looking at the technical side of things, we're seeing a bit of a spike up here, obviously a rally in a couple of those value and cyclical names during the week, allowing us to see a rally in the number of stocks trading above their very short-term moving averages. But we are a little depressed on the stocks trading sort of in their medium and long-term moving averages, certainly compared to where we were a month ago. That's the blue line. We are, however, a little bit better than where we were a week ago. That's encouraging. But with about 50% of stocks sort of above their medium to long-term moving averages, it's hardly convincing for the markets. We'd like to see that at 60% or higher. That's getting to the point where we're saying that there is a healthy participation in this bull market. So a lot of sectors still underperforming, and therefore a little bit of caution being sounded by that data. Have a look at the week ahead. We've got a speech today by Philip Lowe, the RBA governor. He'll give us an update on what he thinks about those rising interest rates the market is obsessed with at the moment, so it'll be nice to have that update. Later in the week, we will get our unemployment data. The previous reading there, 6.4% and 29,000 growth. I don't have any forecasts yet on that one. We will get an RBA bulletin and another speaker there from the RBA before we get retail sales on Friday. Have a look at the data for the rest of the world. We'll kick off with China and Europe first. A data dump, we call that one today, where you get fixed asset investment, industrial production, retail sales, unemployment rate, foreign direct investment, all hitting us today. Then in Europe, we've got the ZEW Economic Sentiment Survey coming out. We've got some inflation data coming out later in the week, and then it's all a bit of a muchness from there. In the US, retail sales coming out on Tuesday. We do have some housing data here, quite closely watched because that is a very strong sector of the US economy at the moment, but more closely watched will be the FOMC meeting, where we will get an update on interest rates over there, and again some more commentary on those rising long-term bond yields, and then we'll close the week out with weekly unemployment claims and the Conference Board leading index. Okay, you can catch all of our other market news updates, news, views, opinions at the market news section of the website. You can follow me or the Think Markets handles on Twitter. You can register for our webinars through the webinars section of the website. We've got Ask the Experts coming up Wednesday, where you get to bring your portfolio and control the conversation. I will analyse the stocks for you as you call them out. The week after that, we'll do how to create an investing plan. Absolutely crucial information for anybody who's managing their own money. And then on the 7th of April, we'll be back to our 3 stocks series, so 3 ASX turnaround stocks. And I wonder if Treasury Wine Estate will be on that list. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than you deposit, so read this disclaimer carefully, and if you have any problems or questions, please give us a call. Thanks for joining me this afternoon. All the best for your trading. Until we catch up again, bye-bye for now.